What was that spike that even happened? What caused that?
Oh, there's some believing that there was a liquidity crunch going to the end of November, a small one which pushed the SOFR rate up, but it's not material, right? Again, this rate's back down to pretty much where we've been all since September. So there's not much of a shift there. It was a short spike, and the SOFR does that, right? You'll see like these short spikes and come back down. This was more of a big spike, but it only happened over 2 days.
But like
So
with the reverse repo going near zero, doesn't that kind of breed an environment where we can see more volatility here?
yeah, 100%. Like this SOFR, the moves in SOFR should start pinning up towards the red line to the IORB rate. And that's something that we can just take a look at in terms of reverse repo, right? Um, let's see if we can get the reverse repo is still at 821 billion, right? So the reverse repo balance is still way up there in terms of historical highs. Like this can go down quite a bit. We're down greatly since the top, but we're still not really back into that normal-ish range down here in like the 2 to 300 billion.
Yeah.
I think the situation in the SOFR in the short-term funding market is going to continue, right? Until we can see the reverse repo really get down there, and then once that happens, once money really is vacuumed out of here, pretty much the rest of it, right? Excuse me, as a good part of it already has been. Then I think we start to see that SOFR pin up towards the red line and potentially trade above the red line. And I think it's only until we see this SOFR rate here trade up to the red line that we're even going to have the conversation about, or we're going to even start having conversations about the Fed ending QT. Obviously, right? The Fed is looking at the stress in markets, the excess in reserves in their schedule for quantitative tightening. Everyone likes to think, oh, the Fed's just watching the stock market. If the stock market shits the bed, well, the Fed's going to cut QT.
What did the Fed do last time the SOFR rate had issues? When was that? Was that like in 2019 or something?
Yeah,
Where it
so
started
that
breaking
was
out? Yeah, like, aren't they able to fix and address that issue without ending QT? Like, don't they have
yeah,
other
no,
tools that they can do to fix that
yeah,
issue?
they called this not QE, this thing.
Yeah,
It was QE,
it's
not
still
QE.
QE. There's no.
Yeah, to a degree. Like let's just take a look at the Fed balance sheet, right? So it's go to price scale. Like once this bullshit happened here with the SOFR, look what happened to the balance sheet.
Yeah.
Started
Okay.
going up. So I mean, I think for the Fed to really control the SOFR rate from blowing out up, they need to do QE is going to need to come back. Because realistically, what happens when the SOFR rate blows up across the IORB rate, there's not enough reserves in the system. So that's like the Fed signal, like, okay, we've gone too far.
Yeah.
Um, I think that we don't have to worry about that at the moment, though, right? Because obviously the SOFR rate remains very tight. We're still only 2 basis points off the reverse repo floor. So that's not, we got to be at least 10. We'd have to be trading tightly towards the IORB rate in a tight range up near the red line here for that to be some even consider for the Fed to even consider that they've gone too far with QT and possibly stopping QT. If the Fed wants to be proactive, if they see this rate climb to the IORB rate and they don't want to see it really push above, the Fed can start adjusting QT, or they just wait for a blowout and then they roll right back into QE. Depending on how they want to operate, we'll see how that happens. But obviously, I think that the reverse repo we still have to reduce some funds over there before we roll into
Well, is a
even talks of
blowout
QT.
above the IORB something that is going to happen? Like, is that just a criteria for stage four?
No, not necessarily, because what can end up happening realistically, if like remember the state. So yeah, I see what you're saying. It's going to have to blow out for the full stage four effect because you're going to need the Fed to have over tightened theoretically to get that SOFR rate above the IORB rate. But the Fed can somewhat manage a sort of, I don't want to say soft landing, but manageable landing where they're able to reduce the pace of QT if the SOFR rate really starts picking up and people start getting concerned, or the market starts getting concerned that the Fed's starting to remove too much liquidity. Ideally, they're not going to make the same mistake they made in 2019. So I do think that they have the ability to at least control the short-term funding market and manage that landing. I'm not saying it's the soft landing. I'm not saying that they're going to thread the needle with the economy here and we're going to completely avoid stage 4. I'm just saying that the blowout in the short-term funding market essentially doesn't need to happen for stage 4. It would be a something that would make sense in stage 4, but it doesn't need to be a part of stage 4 if the Fed can manage it correctly. But then this goes back to the whole stage 4, where the reason stage 4 happens is the Fed stays too restrictive for too long. And this doesn't necessarily mean that the Fed is doing QT for too long. More so, the Fed has interest rates too high for too long. So the Fed can essentially slow QT without raising rates, without cutting interest rates proportionally, right? So what they can do is basically they could stop QT and
Well, by QT, do you mean their balance sheet reduction?
Yes, right? Because just because the Fed does reduces interest rates by like if the Fed were to cut interest rates by 25 basis points, right? And the balance sheet would remain the same. I wouldn't consider that QE.
Right, because that's only half the equation.
That's only half the equation, right? You're going to want to see that balance sheet accelerate. So to clarify what I was saying before, just because the Fed, in terms of threading the needle, right? The idea behind stage 4 is that the Fed will remain too restrictive for too long, meaning the Fed funds rate will be too high for too long. And in the process, they're going to run QT. I think that the Fed is most likely going to either pause the balance sheet reductions. Either these are one of the two things that are going to happen. The Fed is not going to leave interest rates unchanged and start undergoing QE. So, in my opinion, I think what's going to happen is we're going to see two scenarios. Either the Fed is going to pause with QT and start reducing interest rates at some point. The first being the pause of QT and then gradual reduction of interest rates, or they're going to end up overstaying their welcome and they're going to have to flip the switch on both reducing interest rates and kicking back to QE pretty much at the same time. Stage 4 really is around the fact that the Fed is not going to be able to stop QT, then go over and have interest rates in a favorable spot in a acceptable amount of time before the market really ends up being over tightened. Now, let's go into the whole over tightening aspect. Is there a current tightening effect in the economy? Yes, there is. Is the economy over tightened at the moment? No, there isn't. And this is exactly what stage 3 is about, right? The economy isn't feeling such an over tightening effect. Jobs numbers were good today on Friday. The JOLTS numbers are coming down. Labor market's coming more into balance.
Well, jobs numbers are going to be a delayed indicator. Like bonds are always going to move first, and we're actually already starting to see the move in bonds happening.
I don't think we're seeing the deflationary move in bonds happening just yet. I think that this is a good sign, but there is a difference between bonds gradually going up and bonds really excelling from material rate cuts, right? And let's talk about this. So let's look at the 30-year, right? So the 30-year is down. We can take the measuring tool here just to get, 30-year is down about 87 basis points from the high in October, from about 5.2%. We're at 4.3% right now. So there's been 100 basis points of Fed expectations on the long end that have shifted, most likely a duration change, right, from the U.S. Treasuries. What's going on here is pretty simple. This rate is not diving lower; it's gradually coming down, and we can see this across the curve. We go down to 10-year, 5-year, right? This rate's from 5 on the 5 years down to 5 from 5 to 4.2 on the 30-year. Like I said, just 5.2 to 4.3. What's going on here is the expectation of the Fed having to hold at 5.25 is coming down, right? The idea is that the Fed doesn't need to essentially hold at 5.25 for a long time. They can perhaps hold at 4.5, 4.25, 4%, right? That again, long term, the Fed at 4% is not deflationary because that would still put if the Fed's target is 2% inflation, right? And the Fed's expected to cut 100 and odd basis points in the next year. The Fed's still above their targeted inflation rate in terms of the treasury yield. The real yield should theoretically still be positive, right? And what that's going to do is it's going to create a still tighter environment, even though rates are coming down. Yes, inflation's coming down too. So if the Fed were to do nothing in this time frame, right, they would essentially just gain momentum in tightening without actually tightening anything, because what would happen is the inflation expectations would start falling, would start slowing, slower and slower and slower, or lower and lower and lower, excuse me. And the Fed would be sitting there at 5. So what ends up happening is the anticipated real yield, take any tenor minus the inflation expectations, which are falling, and what ends up happening is you get a higher and higher real yield. And what I can do is I can actually bring up we can actually bring up real yields real quick, or break evens, excuse me, and we can see what is going on there. And you will see that break evens are at the bottom of the chokeout zone. And this is a chart that we brought up many times in the podcast and on Twitter. And we made this chart pretty much around, I think it was like May or July. It was at least, it was about, I think it was
Yeah, it
more
was
than,
somewhere around there. It was after SVB. I remember that.
right. So it was at least 6 months ago we started bringing this chart up in our content. And what this chart is showing you is that the Fed is pretty much accepting will accept will accept inflation expectations to wander in between these corridors of 2.5 and 2% on at least the 5+ year duration, right? And what this is showing you is that unless we start breaking out above 2.5, we're not going to see an acceleration in hikes, which we haven't seen really since we dropped this chart. The Fed actually raised one more time and then they've paused since, right? So we're going to have a Fed meeting next week at FOMC, and we're going to see where they go from there. But long story short, the Fed hasn't really done much since we accepted firmly below here after SVB, or excuse me, in the last 6 months. And I think that the Fed won't do much until we see the inflation expectations start breaking below 2 and really start showing the Fed that their inflation expectations are falling fast below their inflation target, and they can start reducing interest rates. So I think that once we start to see the break evens break below 2 and start treading lower, the Fed will be inclined to gradually reduce inflation, the interest rates, to keep the adjusted real yield, the short-term interest rate, or the treasury rate, which is basically set based on the Fed's front end, right? The Fed being the front end, versus the inflation expectation for the same duration. So if we were to take a 5-year US Treasury and we were to subtract it from this value, what we would get is we would get the 5-year real yield. And what that is showing us right now is a positive rate of 2.18%. So if those inflation expectations I just showed you continue to drop and the Fed doesn't do anything, what's going to happen is this is going to expand and become tighter and become more restrictive on the economy. And the Fed obviously is restrictive enough, and they know that, so they don't want to over restrict the economy. So if break even start falling, what they're going to do is they're going to gradually bring rates down. It doesn't mean that that necessarily QT needs to end, right? Because we're talking about 25 basis point cuts along the
Yeah.
lines. We're
Well,
not talking
so
about,
if break evens are positive, is that still a QT environment? And to get a true QE environment, we need to have negative break evens. Is that kind of how it works?
no. I think what ends up happening is you can get Q. I mean, we had QE all up in here, right? So rates were positive. I don't think you need negative inflation expectations for QE. I think it would obviously, that if that happened like in the next month or two, that would be severely depressionary. Like that would be extremely deflationary, right? Slash depression-ish. If we go from +2% inflation expectations to negative in the next like 30 to 60 days, a catastrophe, a nuke must have gone off for that to happen, right?
Yeah.
So I don't think we're going to see that for a long time. COVID was that event that got us from 1.6 to negative to barely negative, not even negative. COVID didn't even get us negative theoretically, and then it bounced back. So I don't think we're seeing negative inflation
No, sorry,
expectations.
I meant negative real yields, not negative break evens.
Oh, negative real yields. So yeah, no. For the negative real yields, what's going to have to happen is that you're going to get negative real yields with the Fed cutting interest rates. So if we were to look at real yields again, right, we're going to look at the nominal. So we're going to do US 05 year.
Yeah. So, like, is it possible to have a QE environment while real yields remain positive?
Yes, yes, that's what happened here. But in that QE environment, real yields start grinding lower towards zero.
Right. So it's more so the rate of change.
The rate of change should slow here on real yields if you enter a QE environment, because obviously the Fed's doing QE because inflation is well below, is at or below target, right? So you have slow inflation, and you have some type of issue with liquidity, right? If it's bank reserves, or there's a funding issue, there's a shortage of capital in the markets that the Fed thinks, right? And typically, unfortunately, what happens is the Fed always injects more than they pull out, so the balance sheet will just seems like it will get bigger and bigger over the long run. That's pretty much what's going on there.
Yeah.
But yeah, I mean, we can look across even at high yield spreads, right? Like high yield option adjusted spreads, and like they're pretty much at multi-year lows here, right? Going back, or at least 52-week lows, right? Going back to December 2022. Yeah, we're plus 52-week lows here on the high yield credit spreads. And I think that that's just something, another indication that stage 3 is continuing. The economy is absorbing this tightening. The Fed is becoming more and more. I mean, you're seeing commentary. We've heard commentary from Powell over the past 2 weeks that the Fed is even considering more tightening if necessary. So they're just open to the idea that they may need to do more tightening. And that's a stance that they're going to continuously hold until the market really starts showing some stress. And the concept of the compound landing across its 4 stages, and the compound landing has its name because it's a unique situation. This is not how every recession happens, right? This is just the
This is like
unique
the
situation.
inflationary recession. This is how they play out.
Pretty much, this is this specific type of scenario that we're in, and the lag between the Fed, the inflation that the Fed was calling not transitory and it running away from them, and then them hiking egregiously into it, right? And then having to wait the lag out. Like, it's such a perfect storm. That's why we call this the compound landing. It's a landing of many levels, right? So stage 3 is exactly this. It's the idea that the Fed can basically tighten and not slow the economy to the point where everyone expects them to do that. And we dropped the back 2 parts of the compound landing, stage 3 and 4, in August, and we elaborated that obviously things like commodities can go up or hold a bid, which they have since August, and they are starting to break down, which is a good sign that we're moving more through stage 3. But the idea is that even though the Fed has been so tight and so restrictive in the economy, the market seems to not care. And that's because there is a lag between what the Fed has done and how the market feels it. And there's just a lag to the whole business cycle. So that lag is long and variable. There's not really a definite time period you can put on it. A lot of people like to say it's 6 months, it's a year, but you really can't put a finger on it. So the idea is that the Fed is going to remain restrictive until they start to see weakness in the economy. The problem is the way that they're going to see weakness in the economy is by the delayed economic figures. The idea behind stage 3 is that the Fed will tighten. The market will not price that in because the economy is not reacting as we've seen it, right? So the economy is not reacting. The market's not going to price it in. Things are not slowing theoretically. Things are slowing, but they're not slowing fast enough. And what ends up happening is the Fed just looks at it and says, okay, we can hold. Meanwhile, the market and economy really are building the slowdown. And by the time the Fed sees it, they've over tightened. And that leads us into stage 4. So that's really where stage 3 and stage 4 meet each other. And that's the whole theory behind stage 4 being the outcome of the Fed being too restrictive for too long and not being able to thread that soft needle landing. I do think that there's always a chance that the Fed could wake up and manage. All they have to do is come out this week and say, look, we're going to run QT. indefinitely for the time being until there's a stress in liquidity. But we're going to start gradually reducing interest rates. They could get away. The Fed could reduce interest rates by 25 basis points right now, and I don't think they'd have an effect on inflation. I really
Yeah,
don't.
I don't think so either. Maybe in the housing sector, honestly, it seems like everyone in the housing sector is kind of gridlocked right now. And as soon as they get an indication that the Fed is cutting interest rates, they're going to jump in again.
I think that the Fed, so that's a good point that you made, right? So like the Fed can cut interest rates by 25 basis points. And here, and this is where it gets really interesting with the compound landing, right? From stage 3 to stage 4. The Fed can cut interest rates by 25 basis points. And that would be the right thing to do at this next meeting to start threading the needle for the soft landing. But the reason why they can't do that is because if they start cutting, the market's going to start thinking like, oh, like we're back into a cutting cycle,
Yeah,
right? Because the
exactly.
market's very linear.
It's not the 25 basis points cut that's going to make an effect. It's the idea that they're going to continue to cut and that
Right. And
the whole hiking cycle, everything is over and QE is coming back.
right. And in the next two meetings, they could reduce interest rates by 50 basis points overall, and I don't think they'd have an effect on inflation. But what they will do is they'll have an effect on forward expectations and break evens and so on and so forth, because they believe that if if inflation starts moving up, the Fed will have to then or the Fed's easing conditions too fast, right? And therefore inflation could spark again. Inflation expectations start getting out of hand. Price forward contracts start going up, and people start expecting inflation. Then eventually inflation somewhat happens, right? That's how this works. So the Fed is almost forced to hold for too long, unless they want to play the gamble of moving rates and possibly altering forward rate expectations after they have been adamantly stepping in front of the ball here and saying that they will remain restrictive for a while. They don't see rate. Didn't the Fed just a couple of months ago or a couple of meetings ago said there's no rate cuts in 2024? Didn't they say that?
Yeah, I
Rate
think they
cuts
did.
until 2025? It was
Yeah, yeah.
2025, right?
Yeah. Well, that's during the time when they did say that, they needed to say that. They needed to let everyone know that they're not messing around and that they're here to keep rates high for a long time because that's what they
I'm,
needed to get inflation down to where it is today.
I know. And
Otherwise, the expectations would have been, oh, they're going to probably start cutting in the next 6 months.
Right. And Powell pretty much played hardball with the market, and that was great. But like my question is, with 100 plus basis points of cuts being priced into the market, what is Powell going to say next week? Is he going to say something along the lines of, we won't cut interest rates until 2025 again? Is he going to repeat those lines? Because if he does, I think we're going to see quite a shock. I think we're going to see quite a shock. It's like everyone's going to realize that the Fed really isn't playing around here.
Yeah.
But I
Which,
don't. We'll
what
have
do
to
you
see.
think that's a good thing?
Like I said, I think the smart thing to do would, you could even go along the lines of cutting rates 25 basis points every other meeting at this point. I think you're getting to the point where like even just break even expectations,
But
right?
why though? At the end of the day, what has really changed? The economy is still hot.
Well, it's not hot, right? Real GDP, we had one hot quarter at 5%, but now we're down to one, right? Like remember the goal here is the soft landing, not the hard landing. The Fed wants the soft landing, right? And
Hmm.
I'm telling you in perspective of being a someone that works at the Fed and trying to achieve this soft landing. I'm not going to wait to start cutting interest rates. I'm not going to wait until there's negative GDP on forecast to start cutting interest rates, right? If you want to achieve the soft landing, wouldn't it be you just put 525 basis points of cushion from zero to now in the last 2 years under your belt. Inflation is at 3.2%. Real yields on the 5 year are north of 2%. Not that that's extraordinary, but if you want to achieve the soft landing, you have wiggle room here. Like you can reduce the Fed funds rate by 25 basis points at this meeting, and maybe not next meeting, but the meeting thereafter, right? And what would happen is you will drop the real yield a little bit. Yeah, it will be slightly stimulative to the economy, understood, but I don't see how you achieve a soft landing without at some point stimulating the economy with reducing interest rates. What are you going to just hold interest rates at 500 basis points, 525 basis points, and the economy is just going to magically turn around? And like even if inflation goes to target, right? Like let's just say the 5-year inflation expectation stays at 2%. You're saying that we're going to be running a 2.25, 2.25 real yield on the 5-year. I don't know if that's really something that we're gonna see. I would like to see that, but I mean it's something that we saw going back in 2005, 2006. We got up to a 2.5% real yield, but I don't think that this type of environment, the way that the companies are structured, growth has really been. Could we see a capital structure change? Maybe, but or in terms of an investment structure change where people are focused on less on tech, right, and more on the value companies, maybe. But I just think the market's very driven on the entire demand structure for debt has shifted to where people believe that 7-8% mortgages just aren't realistic, right? And this goes back to the inflation expectations too. Like, so let's briefly talk about this, because going into 2005, 2004, like if we were to mark where the Fed's target on inflation is, right? Like let's just say ballpark it, right? Just here, we'll make it. But the inflation rate is 2%. In the 2004, 2005 era, inflation, when we saw those 2.5% real yields, inflation was above that 2% trend. It was only until post 2008 that inflation really started settling below that 2% level. And the Fed is pretty much solidified themselves on getting inflation back to target. So the question now is, how does the Fed get inflation back to target without getting to target and blowing through it? Something like this, for example, in 2008, you don't want to see them blow through it. This was a credit crisis, but even in 2014, we blew down to negative 11 basis points on. We had like a short if it was one month negative inflation print, right? And I think that the Fed doesn't want to see inflation fall off a cliff, and obviously nobody does, because that's negative for the market. And the economy. So the Fed wants to manage a soft landing. And I think to manage a soft landing, you're going to have to start cooperating with the slowdown in inflation by rewarding the markets with slightly lower interest rates. I don't think that you can just hold indefinitely and then let the markets go down to 2. And then what's going to happen is if the markets go down to 2 and the Fed doesn't cut, I mean, if inflation goes down to 2 and the Fed only starts cutting, then I think you're kind of, like we said earlier, right? The interest rate effects don't show up in the market right away. So the Fed's going to start what? Are they going to start cutting by 100 basis point clips? They're at 5.25.
Yeah, they would just be panicking at that point.
Right, because like what happens? Like remember, the Fed has what, 6 to 8 meetings in a year, something like that, right? So like, what's the Fed going to do? Cut a big one rate cut at every meeting? If inflation goes down to target in the next 2 months, 3 months, right? Let's just hypothetically say this. The Fed's going to be in Schitt's Creek, because what's going to happen is if inflation goes to target in the next 3 months, this is hypothetical. Well, 6 months is probably a better time horizon, right? If inflation goes into the 2s in the next 6 months, maybe not 2% flat, but we're in the 2s within the next 6 months. What happens? The Fed's at 5.25. They can only reduce rates unless they do emergency rate cuts. They have a certain amount of time to reduce those interest rates, right?
Well, so they're also going to be late at that point, because then they have to wait. There's going to be a 6 to 9 month lag until the effects of that rate cut actually seep into the system.
So if you think about stage 3 and stage 4, it's amazing when you think about it, because like for the Fed to achieve the soft landing, in my opinion, they have a very small window for that soft landing before they end up actually bleeding over into a panic mode, right? Because they got to start reducing interest rates, even if it's 25 basis points every third meeting. I don't know, do something, right? Inflation's at 3.2%. What are you going to sit up here for 5.25 to show you're resilient forever? Like, you're going to have to start reducing interest rates at some point. And maybe I'm wrong. Maybe the Fed is too scared of cutting interest rates and running QT at the same time. Maybe they think that it'll be a public misconception that what they're doing. Maybe what it'll do is it'll invalidate one of those two things. If the Fed's cutting interest rates to stabilize the economy and still running QT, would that mean that every time the Fed did QE, it was worthless? Right? You got to think about that. Like if the Fed can start bringing interest rates down to bolster the economy, then why even have QE to begin with?
Yeah.
You got to ask yourself that, right? Like, is the Fed stuck to some mandate that we don't know? Possibly. I don't know. I'm just talking off the top of my head, right? If we look at the situation in hand, it's real simple. Interest rates are high. They're above the rate of inflation. They're above pretty much all the inflation swaps. Inflation, we are in a real positive interest rate environment for quite some time now, a year plus. And the Fed's going to have to start making a decision rather quickly if they're going to start reducing inflation, interest rates to loosen conditions just a little bit, loosen conditions just a little bit to prep themselves for a soft landing. If they can't do that, when do they do that?
Well, is that what the bond market is telling us right now, that they're anticipating the Fed to have to do that? Start thinking about cutting rates?
If you're thinking about it, think about where the Fed funds rate is right now. We're at 5.25, right? They're expecting the Fed to cut 100 basis points over the next 12 months, right? Makes sense, right? That's pricing in a soft landing, because if you cut interest rates by 100 basis points over the next 12 months, inflation today is at 3.2%. The Fed's going to remain in a positive real yield environment this entire time in expectation, right? So we're going, and I'll annotate this. So so those that are watching me, assume we're here right now, right? Assume we're up here. If we take 125 basis points off this, we're here. So you would assume by end of 2024, right? Inflation's probably much closer to the Fed's target if we remain restrictive, unless something breaks out. But that's still restrictive. So this is what I'm saying. The market's pricing in this environment exactly what I said the Fed should do, is bring interest rates down gradually, or like slowly lower slowly, however you want to say it. They should bring rates down at a gradual pace to keep conditions in check, keep them somewhat soft, not keep them somewhat moldable, not completely soft or easy, just so you can guide yourself into that soft landing. Make the landing nice and soft. What ends up happening is if the Fed comes out next week and really lays out the plan saying that they are going to stay at 5.25 and they're not moving their ground, they want inflation at target. In my opinion, that just reverse prices what the bond market has to say, right?
Yeah.
Like the idea that the bond market's saying like, oh, the Fed's gonna loosen, right? In the next, even we can use 2-year, right? 2-year moved up today with the jobs number. Realize that the 2-year pumped up about 13 basis points because the jobs numbers were good, and the idea is that the Fed's not going to cut until they see a weak labor market or more of a stress in the labor market, plus the SOFR market, right? Which again, that's also not being stressed. That's also pretty calm right now.
So bonds were kind of getting ahead of themselves a little bit.
A little to a degree, but what they're doing makes sense, right? They're pricing in that look. They're pricing in, this is what bonds are pricing in. If we're going to have a soft landing, the Fed can't stay at 525 basis points for the next 2 years.
Yeah. So the odds of having a lower rate, regardless of having a hard landing or a soft landing, is high, because those are the only two options: hard landing or soft landing. We're not staying where we are today.
And why do you think TLT bid off the lows like this?
Yeah.
For that reason. But that's not to say what happens if the Fed comes out and stiff arms the market and says we're going to hold rates here for the next year. The market's probably not going to believe them, to be honest. I mean, Powell's been pretty hawkish and the market doesn't really care. But at some point, the market's going to be proved wrong unless stage 4 hits. And we have a checklist in the ledger in our members area on the website that elaborates more on what checkpoints need to be hit to get to stage 4. And we're not really seeing stage 4 right now, right? So it's like, what are you preparing yourself for in the bond trade? Listen, bonds are up. It's really starting to look like we could get a bond trade some point soon. I'd be happy to jump into the long bond trade, but I need stage 4 to happen for that to be a trigger. Without stage 4, what this is a fake out. Because without stage 4 happening, the Fed's not going to materially reduce interest rates. This is the Fed. This is the expectation of a soft, this is the soft landing pricing going on here. That's what this is. This is the market pricing in the Fed gradually reducing interest rates over the next 1 year, year and a half, but not too much.
Yeah.
To land
The
this
hard
economy.
landing pricing is going to be much more volatile.
Yeah, the hard landing pricing is the idea that the Fed needs to get down to 3%, 2.5%. Because they've over tightened, or even worse, they need to go down under 2 because they sent inflation under 2%. So if you guys are watching and trying to understand how the hard landing is playing out, just remember, for the Fed to achieve the soft landing, they need to start really moving down interest rates. Otherwise, what ends up happening is you're putting in too much of a gap between where the Fed is now and where the Fed will be or where inflation will be in the next few months. And every meeting that goes by, if the Fed doesn't do anything, the gap widens and widens until everyone says, oh shit, the Fed's going to start reducing rates by not 25 basis points, but 50 basis points every meeting. Okay. And everyone will be like, oh my God, we're going into a recession. Maybe the Fed even jump up to 75 basis points. And by then, we're in the hard landing. We're in stage 4. So I just want to clarify with those that are paying attention, look at the big picture of things. This move up in bonds is a good thing for the bond bull. For anyone most of the bond bulls are long TLT from 100 anyways. So this is just getting back to even for them, which I'm happy for them because they were underwater quite a bit. And down 20% on bonds is not fun. And I think that this is a nice comeback for them. But I think for us to really get this bond trade going, we're going to need to see a bullish ZB trend flip, which we're still not even at Momo. And we're going to need to see that stage 4 progression start to appear. Again, we're not seeing that quite yet either. So stage 3 continues. Credit spreads are not bearish at the moment. They're just, it's not a bearish signal. Like they're at 52-week lows. So I think that
real yields are still way too elevated.
Yeah,
those need to go bearish trend. The dollar needs to break out. The dollar's been actually doing the opposite of what it should be doing in stage 4.
Right. And I think that because of all this, stage 3 beats on, right? The idea of the normalization, which is what stage 3 is called, where the economy can function well at high interest rates and restrictive conditions don't really affect it, is going to beat on. And the market could see higher prices. And I think that's fair to say, right? Unemployment ticking lower today. Jobs report good. Job openings coming down, but again, not crashing.
Yeah,
Coming down quite a bit.
Growth remaining solid.
Growth remaining solid, but not slow.
Not exceptional, but not terrible.
Extremely slow from the last print, but not terrible. And therefore, the market can try and chug higher. And I think that that was our outlook pretty much all here in Q2 and pretty much all of Q2 and part of Q3 in earlier this year. And once we went bearish trend, we obviously said, okay, market can go lower now. The trend, given that might be an early indication of stage 4, and we were proven wrong here when it went bullish trend in late last month. And since then, market can go back to its stage 3 pricing of trying to normalize and peak soft landing pricing and getting everyone baked into the idea that the soft landing is going to happen. Bond market's been doing it. Stock market's back to near 52-week highs. It's been doing it. So I think actually didn't the SPY close at 52-week high? Yeah, the SPY index is so the SPX actually closed 52-week highs. So the market's pricing in soft landing. The stock market's pricing in soft landing. The bond market's pricing in soft landing. Volatility is pricing in soft landing. Everything's pricing in soft landing. So now, Fed's up at bat. They're the ones that have to prove that they're gonna be able to achieve a soft landing. I think they need to start talking at some point here, or at least give guidance for the possibility of rate cuts. And if they're completely hawkish, I don't know how the market's going to like that. But we'll take a look next week and we'll report back to you what we hear and what we see based on the commentary from Powell and what we think of it and what the market most importantly thinks of it. But until then, guys, thank you so much for listening. If you have any questions, feel free to reach out to us on Twitter at The Market Radar, or go to our website at market-radar.com for access to our models and insight. Thank you.